Everyone would love to see the effects of the dividend snowball. Having a massive portfolio that spits out huge dividends day after day, thousands of dollars, is a dream for most investors. The good news is it's really achievable. Building a massive dividend portfolio doesn't happen overnight, but with the right strategy, patience, and discipline, you can create a snowball effect that turns small investments into life-changing wealth. We'll explore how to do that in today's video. Welcome back to the Financial Freedom Show. In today's video, we're going to be diving into one of the most exciting concepts in investing, the snowball effect on dividends, and how you can leverage it to build serious wealth through dividend ETFs. If you're ready to learn how to make your money work for you, stick around. This is going to be a game changer. Later on, we'll cover the latest news. A high-ranking executive in United Healthcare was actually just shot in broad daylight in New York City. Before we get started, how would you like to have your name at the end of every single video from now on that I produce? I recently opened the channel's membership section, which allows you to have certain perks over regular viewers. You can get early access to videos a day before I post them on the channel, access to our private Discord server, and much more. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest in future videos. Without further ado, let's get into today's video. So let's start with the basics. What exactly is the snowball effect when it comes to dividends? Imagine a snowball rolling down a huge hill. As it picks up snow, it grows bigger and bigger, and the faster it rolls, the more it collects. That's exactly how dividend reinvestment works in your portfolio. When you invest in dividend-paying ETFs, you earn regular payouts. And if you reinvest those dividends back into your ETF, you buy more shares. More shares means more dividends, which means you can buy even more shares. Over time, this compounding can turn small investments into significant wealth. So why focus on dividend ETFs? Dividend ETFs combine the power of diversification and consistent income. Instead of investing in individual companies, you're investing in a basket of dividend-paying stocks, which spreads out your risk. Dividend ETFs are investment funds that pool money to invest in a diversified portfolio of dividend-paying stocks. Unlike traditional individual stocks, ETFs provide instant diversification, reducing the risk associated with relying on the performance of a single company. These funds often focus on companies with a history of stable or growing dividends, making them a very attractive option for both income seekers and growth-oriented investors. What sets dividend ETFs apart is their ability to reinvest dividends automatically through a dividend reinvestment program, or DRIP. This dividend reinvestment is where the magic of the snowball effect begins. The snowball effect is a metaphor for how reinvesting dividends accelerates the growth of an investment portfolio over time. Each dividend payment buys more shares of the ETF, which in turn generates more dividends. Over time, this cycle creates exponential growth, akin to a snowball growing larger as it rolls down a hill. For example, if an investor owns an ETF that pays an average dividend yield of 3% annually and reinvests all payouts, the compounding effect begins to work. In addition to market returns, the reinvested dividends continuously enhance the number of shares owned, leading to larger future payouts. If given enough time, even modest investments can grow into significant wealth through this compounding mechanism. Consider an investor who starts out with $10,000 in an ETF that's offering a 3% yield, and he reinvests all his dividends. Assuming an average annual growth rate of 7%, including market returns, the portfolio could grow to over $76,000 in 30 years without any additional contributions. If the investor adds to the investment regularly, the growth accelerates even further. The snowball effect becomes even more pronounced when the dividend payouts increase over time. ETFs focus on dividend growth companies, such as the iShares Core Dividend Growth ETF, or DGRO, can amplify returns as reinvested dividends purchase increasingly valuable shares. While dividend ETFs are powerful, they're not without challenges. High expense ratios can eat into returns, and chasing ETFs with unsustainably high yields can lead to disappointment if dividends are cut. Investors must perform due diligence and choose ETFs with a proven track record, reasonable fees, and a sustainable dividend policy. Additionally, the snowball effect requires time and patience. Investors should resist the urge to sell during market downturns, as this interrupts the compounding process. Staying invested for the long haul is crucial to unlocking the full potential of dividend ETFs. Dividend ETFs spread investments across a range of dividend-paying companies, industries, and sectors. This diversification helps minimize the risk of any single company's failure, affecting the overall portfolio or dividend yield. For investors seeking stability, many dividend ETFs focus on blue-chip companies known for their financial strength and consistent dividend history. Dividend ETFs provide a reliable stream of income, making them especially valuable for retirees or those seeking passive income. The predictability of payouts offers peace of mind, even in volatile markets. Investing in dividend ETFs is straightforward and requires minimal active management. Automated drips ensure that dividends are reinvested seamlessly, allowing the snowball effect to take full effect without requiring constant oversight. Many ETFs emphasize companies with a history of increasing their dividends, such as the Vanguard Dividend Appreciation ETF, or VIG, or the Schwab US Dividend Equity ETF, or SCHD, which we've talked about on this channel before. These ETFs provide not only current income, but also the potential for capital appreciation, creating a dual benefit for investors. Compared to individual dividend-paying stocks, ETFs can also be more tax efficient due to their unique structure. Certain ETFs qualify for favorable tax treatment, making them an even more attractive option for wealth building. Several factors can influence how quickly the snowball effect works in your portfolio. The first thing is dividend growth. By investing in companies or ETFs that increase their dividends annually, it accelerates the snowball effect. These growing dividend payouts mean that reinvestments are larger over time, compounding the growth quicker. Number 2 is time in the market. The longer you stay invested, the more powerful the snowball effect becomes. Time allows compounding to amplify returns, turning modest initial investments into substantial wealth. Number 3 is reinvestment frequency. Frequent reinvestment of dividends, such as monthly or quarterly, helps the snowball effect grow faster compared to annual reinvestment. Number 4 is starting yield. A higher dividend yield provides a larger initial payout, allowing the snowball to start rolling faster. However, investors should balance yield with sustainability and growth potential. And number 5 is additional contributions. Regularly adding new capital to your investments supercharges the snowball effect, allowing you to purchase more shares and generate more dividends. So why is the snowball effect so uniquely powerful? Number 1 is compounding on autopilot. Once it's set up, the reinvestment or drip occurs automatically, requiring no effort from the investor. This allows the snowball to grow in the background, even if you're not actively monitoring your investments. Number 2 is resilience to market volatility. During market downturns, reinvested dividends pay more shares at lower prices. This increases the future payout potential when the market recovers, turning volatility into actually an advantage. And number 3 is psychological benefit. Watching the compounding effect take shape provides a motivational boost, encouraging investors to stay the course and resist impulsive decisions like selling during a dip. For retirees, the snowball effect shifts gears. Instead of reinvesting dividends, retirees can then use the payouts as a steady income stream. By carefully managing their withdrawals, the snowball effect can continue to grow, balancing income needs with long-term growth. The snowball effect in dividends is a testament to the power of compounding and time. Through consistent reinvestment, patient investors can transform modest investments into significant wealth. Dividend ETFs, with their built-in diversification and automated reinvestment features, make it easier than ever to harness this phenomenon. The beauty of the snowball effect lies not in its mathematical elegance, but also in its accessibility. It does not require large initial investments, advanced financial knowledge, or constant market monitoring. Instead, it rewards discipline, consistency, and patience, traits within the reach of every single investor. Starting small and staying the course can yield extraordinary results over time, making the dream of financial independence a realistic and attainable goal for many. Moreover, the snowball effect is uniquely adaptable to various life stages and financial objectives. For younger investors, it offers a pathway to build wealth over decades, allowing small, regular contributions to grow into a sustainable portfolio. For those who are closer to retirement, the focus can shift from reinvesting the dividends to utilizing the steady income stream generated by years of disciplined investing. Even in retirement, the snowball can continue rolling, preserving and growing wealth for future generations. The long-term success of the snowball effect also highlights the importance of mindset in investing. It reinforces the value of thinking ahead, being patient during market fluctuations, and letting time do the heavy lifting. By staying consistent and invested and committed to the process, investors not only grow their portfolios, but also cultivate the benefits and habits and perspective that's needed for a lasting financial success. In a world filled with complex investment options and short-term distractions, the simplicity and effectiveness of the snowball effect stand out. Whether your goal is to achieve financial freedom, generate passive income, or build a legacy for future generations, the dividend snowball effect is a proven strategy that can turn your financial dreams into a reality. Like a snowball rolling down a hill, it starts as small, but grows into something extraordinary with time, consistency, and discipline. By harnessing the power of dividend reinvestment, you can create a self-sustaining cycle of growth that transforms your financial future, one dividend at a time. The sooner you start, the bigger and faster your snowball will grow, making now the perfect time to begin your journey towards lasting wealth. Now we're going to get into the most recent news. A United Healthcare CEO, he wasn't the leader of the actual company, but he was a lower management level person in the insurance arm of United Health. He was actually shot to death on Wednesday outside the New York Hilton Midtown in Manhattan.
At this very moment, there is a manhunt for the person who shot and killed the CEO of a leading health insurer. Brian Thompson was the head of United Healthcare for the past 3.5 years. Police say he was targeted in this morning's premeditated attack outside of the Hilton Hotel in Midtown Manhattan. That's a busy commercial area. Thompson went to a hospital where he died. Police are still searching for the shooter, who had on a mask and was last seen eastbound on 6th Avenue.
He was named the CEO of United Healthcare's insurance arm in April of 2021. He first joined United Healthcare in 2004. In his most recent role as CEO of United Healthcare, he was responsible for leading growth across the company's global, employer, individual, specialty, and government benefits businesses, according to a 2021 statement announcing his appointment. Brian's experience, relationships, and values make him especially well suited to help United Healthcare improve how healthcare works for consumers, physicians, employers, governments, and our other partners, leading to continued and sustained long-term growth. He also held other positions in his 20 years in the company, including Chief Financial Officer for United Healthcare's employer and individual, community and state, and Medicare and retirement businesses. He also served as the financial controller for United Healthcare's employer and individual businesses, and was a director in the company's corporate development division. Absolutely crazy that he even did that in broad daylight. So hopefully they catch the guy. He's still on the run. We'll do another video with an update once they figure out what's going on. It looks like it was a premeditated attack, but it's just absolutely crazy that something like that could happen in broad daylight in New York City. So I hope you guys enjoyed today's video. If you did, please be sure to hit the like button and subscribe in order to stay up to date with the latest in videos from my channel. And check out the membership program. You could join and have your name at the end of every single video, and have access to our private Discord, as well as priority access to videos the day before they're released. Make sure to leave a comment down below what you're doing in your portfolio. How are you building the dividend snowball? And I'll see you guys next time. Thanks for watching.